Welcome back to Investing Talk Podcast. Today we're doing what we do best, taking a stack of detailed sources and getting to the heart of a timely question. Our mission today is to tackle a question many of you might be asking. Is Denison Mines Core a good time to buy now? We're going to unpack all the angles from its financials to its technical indicators and, what future catalysts could be on the horizon for this fascinating uranium player. As we embark on this deep dive, if you find this kind of detailed analysis helpful, please consider subscribing, giving us a like, leaving a comment, and if you're feeling generous, perhaps even buying us a coffee. Your support really helps us keep these explorations going.
Understanding Denison Mines the foundation.
Okay, let's begin by grounding ourselves in the company itself. Denison Mines is basically a uranium exploration and development company.
That's right.
They're heavily focused on the Athabasca Basin region in northern Saskatchewan, Canada.
Mm-hmm.
And their big project, the one everyone's watching, is Wheeler River, featuring the Phoenix deposit.
And what's truly fascinating here, I think, is the broader context. It really sets the stage for Denison. We've seen uranium prices showing, pretty clear signs of recovery after that significant dip in early 2025.
Right, that dip was quite sharp.
It was. And you couple that recovery with a renewed global interest in nuclear energy, which is becoming increasingly relevant. Think about the explosive growth of AI data centers that demand just immense power.
Oh, absolutely. The energy demand is huge.
So it kind of puts Denison Mines in an intriguing spot that's really worth looking at closely. It's a convergence of these macro trends and their specific potential.
So given they're still in that development phase, not full production yet, how should we even approach their Q1 2025 financials? What were the key signals or maybe red flags in those numbers, especially for a company not really generating significant revenue yet?
Well, it's crucial to look beyond just the top and bottom lines for a company like Denison at this stage. Their Q1 2025 results did show a loss of $0 of forts per share, which was actually wider than analyst expectations. Not entirely unusual for a pre-production company, though, but their revenue for the quarter was $0.96 million, and that actually exceeded consensus estimates by a notable 24.42%.
Interesting. So where did that revenue come from? Selling some inventory?
Likely related to their physical uranium holdings, yes, but the consistent earnings misses over the past 4 quarters, that tells us they are definitely in that heavy investment stage. They've poured a lot into project development. About 75% of the total engineering for their Phoenix project is complete now.
75%, okay.
And over $7 million funded for long-lived capital purchases. So it shows progress, even if it's not showing up as profitability just yet.
When I look at the initial snapshot, what jumps out is a $1.65 billion market cap with minimal revenue and negative earnings on a trailing 12-month basis. Yet they've got this strong cash position and zero debt. That combination, especially for a development stage company, seems like a potentially powerful advantage. Am I reading that right?
You're absolutely reading that right.
How significant is that zero debt position in this sector?
Oh, it's huge. A zero debt position offers tremendous financial flexibility. In a capital-intensive industry like mining, especially for a company still developing its main asset, avoiding debt means they aren't burdened by interest payments or, tight loan covenants.
Right, less pressure.
It allows them to fund their ambitious Phoenix project primarily through existing cash or maybe equity without straining their balance sheet too much. This kind of resilience can be a huge differentiator compared to competitors who might need to raise expensive debt, potentially at bad times.
Okay. So beyond that financial strength, what else makes Denison stand out in the, pretty competitive uranium sector?
Their strategic asset portfolio is key, particularly the Wheeler River project with its really high-grade Phoenix deposit. And what's unique is their innovative in-situ recovery, or ISR, mining technique being used for Phoenix.
ISR, okay.
This ISR approach offers both significant environmental and cost advantages compared to conventional mining methods. It basically extracts uranium directly from the ground by circulating a solution, which minimizes surface disturbance.
That ISR approach sounds incredibly innovative, efficient too. But does pioneering a new mining technique like that also come with its own set of unique risks or challenges investors should know about?
That's an excellent point. While ISR offers compelling advantages, it's true that any innovative technique can introduce specific operational challenges, or maybe regulatory hurdles, especially when you're scaling it up initially.
Like what kind of challenges?
Well, it requires very specific geological conditions to work well. And managing the chemical solution underground, that's complex. However, Denison has been doing a lot to de-risk this. They've run pilot programs, done comprehensive environmental assessments.
So they're aware of it and working on it.
Exactly. They seem quite advanced in their overall development, which suggests they're addressing these points proactively. The Phoenix ISR project is progressing towards a construction start in early 2026,
Okay, 2026.
with production targeted for mid-2028. Now, this is a significant timeline. It would make it the first new large-scale uranium mine in northern Saskatchewan since Cigar Lake was commissioned way back in 2014.
Wow, quite a gap.
Yeah. And additionally, Denison holds a strong physical uranium inventory, about 2.2 million pounds.
Which becomes more valuable if prices go up.
Precisely. And they also have strategic partnerships, like with Kosa Resources and Foremost Clean Energy, for exploring some of their non-core properties, which adds a bit of diversification.
Valuation and technicals, what the numbers say.
Okay, this is where it gets really interesting for investors, I think, because when we look at their valuations, some of the traditional metrics look, well, a bit skewed. How should we interpret ratios like PE and PS for a company like Denison Mines still in development?
Yeah, for a development stage company like Denison, those traditional PE or PS ratios are, frankly, almost meaningless on their own. They're wildly skewed. The real insight here is that investors are betting purely on the future potential.
Right.
Their current PE ratio is negative 20.54, because they lack profitability, as you'd expect. The PS ratio is extremely high at 498.92. That reflects their minimal current revenue against a pretty substantial market cap.
Almost 500 PS, wow.
And the PB ratio is 4.49, which is definitely above the industry average of about 2.3. These metrics clearly shout that the company's valuation is based primarily on, highly anticipated future potential. Specifically, the cash flow stream from Phoenix years down the line.
So it's a stark reminder you're investing in potential, not what they're earning today.
Exactly.
That's a crucial distinction. But despite those skewed traditional metrics, Wall Street analysts seem to have a remarkably bullish outlook. That feels like a strong vote of confidence from the pros.
Are there any dissenting voices or alternative perspectives in the market we should consider? Just to get the full picture, even if they're a minority view.
It's important to note that the analyst sentiment we've seen in the sources is indeed unanimously positive, which is quite powerful. The average price target from analysts is $2.60. That represents over 41% upside from the current price, around $1.84.
41% upside potential.
And the highest target is $2.89, offering over 57% upside. Even the lowest target is $2.21, still implying more than 20% upside.
So even the low end sees decent potential. Right. The consensus rating is buy, based on 8 analysts, 5 buy ratings, and 3 strong buy ratings. Now, while our sources don't highlight significant dissenting public analyst views right now, it's always wise for investors to consider their own risk tolerance. Analyst targets are forward-looking. They're subject to market conditions changing.
Absolutely. So given that strong analyst confidence, how is the market actually pricing in that future potential right now? What do the technical indicators tell us about Denison's momentum on the charts?
Well, Denison Mine stock is currently trading around $1.84. That's within its 52-week range of $1.08 to $2.47. It has shown significant volatility over the past year, which frankly is typical for a pre-production commodity leveraged company like this.
Volatility is part of the game here.
It is. Technical indicators generally present a bullish picture, though. Its moving average score is 100.
100. What does that mean exactly?
It indicates a bullish trend across multiple time frames. The 20-day, 50-day, and 200-day simple moving averages all signal positive momentum.
Okay, so broad agreement there.
And the MACD indicator is also bullish, reinforcing that positive trend. However, oscillator indicators like RSI and stochastic, they're more neutral.
Neutral, so not overbought.
Right. It suggests the stock is in an uptrend, but not at extreme overbought or oversold levels that might signal, an imminent reversal. It points more towards a sustainable move rather than an overheated one. Key technical levels to watch. Resistance is around $2. That's a psychological level the stock often bumps against.
$2, okay.
And then $2.47, which was its 52-week high. That's the clear breakout point if momentum really builds. On the support side, what dollars in vein to $1.75 stands at is a recent consolidation area that has held pretty firm.
Good floor there, potentially.
Potentially. And $1.08 to 52-week low, which would be a critical breakdown point if things went south. The stock has been forming a nice base above that $1.70 level, which could serve as a launching pad for future moves, especially if uranium prices keep recovering and they hit their project milestones.
Recent developments and future catalysts.
Okay, moving beyond the current numbers and charts. What have been the most significant recent developments for Denison Mines? And maybe more importantly, what short-term and long-term catalysts should investors really have on their radar?
Well, recent corporate developments, as we touched on, include those Q1 2025 financial results. But a truly major regulatory milestone, one you really shouldn't overlook, is the Canadian Nuclear Safety Commission, the CSC. They've scheduled public hearings for the Wheeler River uranium project for late 2025.
Ah, the public hearings, that's big.
It's huge. This marks the final critical step toward obtaining federal environmental assessment approval. It moves the project much closer to construction. We also saw some strategic partnerships mentioned and some board changes in Q1 2025 aimed at strengthening the company's governance and future prospects.
Seems like they're lining things up.
Feels like it. And analyst actions, as we discussed, have been predominantly positive. Roth MKM reiterated their buy rating in May 2025. Raymond James maintained their buy rating, though they did adjust their price target slightly. National Bank lowered their target, but still kept a positive rating.
So still generally positive sentiment from analysts. What about insider trading? Any signals there?
Insider trading activity, according to our sources, has been pretty minimal. There was a small purchase by the CEO in late 2024, and a sale by a senior officer around the same time. Nothing really indicating a strong directional signal from insiders lately.
Okay, so minimal noise there. All these pieces seem to be moving parts in a larger puzzle. So
Right.
what are the absolute key events, the things that could truly drive the stock going forward, both soon and maybe longer term?
Okay, several important ones. Short term, so next 0 to 6 months. Those CNSC public hearings for Wheeler River in late 2025 are paramount. That's the final stage of the environmental assessment.
Got it. CNSC hearings.
Then, the Q2 2025 earnings report, expected in August. That will give crucial updates on project development progress and their financials. Also, continued recovery in uranium prices from that April 2025 low of $63.45 per pound. That would immediately and positively impact Denison's significant physical uranium holdings.
Right, that inventory becomes more valuable.
Instantly. And finally, mining at the McLean North deposit using the Sabre method is expected to start in mid-2025. That provides some nearer-term operational activity, shows things are moving.
Okay, so hearings, earnings, prices, and some initial mining activity. What about longer term, beyond 6 months?
Looking long-term, the biggest catalyst is the construction decision for the Phoenix project. That's planned for early 2026, assuming they get those regulatory approvals.
Final, go ahead.
Yes, and that decision leads directly to the targeted first production from Phoenix in mid-2028. That event would fundamentally transform Denison from just a developer into a producing company with substantial revenue. It changes the whole story.
It's a game changer.
Totally. Beyond the company specifics, the broader uranium market fundamentals look, well, profoundly compelling. There's a structural deficit in uranium supply that's projected to grow significantly. The gap between production and requirements could be more than 54 million pounds in 2025-2026 alone,
54 million pounds.
accumulating to maybe 336 million pounds by 2035. That's a huge shortfall.
Wow.
An increasing global adoption of nuclear energy, particularly, as we mentioned, for powering new AI data centers, could drive long-term demand even higher. And critically, recent U.S. executive orders supporting domestic uranium production and nuclear energy expansion. Those could broadly benefit the entire sector, providing a strong tailwind for companies like Denison.
The risks and investment considerations.
Okay, it's crucial, though, to look at both sides of the coin when we evaluate any investment. Denison Mines is no exception. What are the key risk factors an investor should be, well, acutely aware of with this company?
Good question. On the company's specific side, the Phoenix project faces inherent development and construction risks. Potential delays, cost overruns, maybe unexpected technical challenges during the actual build-out. It happens.
Construction is never simple.
Never. And regulatory approval, while it seemed to be progressing well, it's not an absolute guarantee. It could still face delays or maybe additional conditions from the regulators impacting the timeline. And despite their current strong cash position, the company might need additional capital to fully fund construction,
Which could mean?
which could lead to shareholder dilution if they have to raise that capital through selling more stock.
Right, dilution risk.
And of course, the projected 2028 production start. That's still several years away. It creates a long runway before significant revenue generation kicks in. Patience is needed.
Definitely a long-term play. What about broader sector risks?
For sector and macroeconomic risks, uranium price volatility is a big one. We saw prices drop sharply from $100 a pound in January 24 down to $63.45 in April 25 before bouncing back somewhat.
So those price swings are real.
They are a reality you have to accept. There's also competition from larger established producers like Cameco and other emerging developers trying to bring projects online.
Crowded space.
It is. And the advancement of alternative energy sources, while vital for the planet, could theoretically reduce long-term demand for nuclear power, though current trends seem to point the other way, especially with electrification and AI. And finally, geopolitical factors, particularly concerning Russian supply and also Kazakhstan's production levels. Those significantly influence the global uranium market dynamics.
Lots of moving parts globally.
Absolutely.
So bringing it all together then, given the substantial potential upside we've talked about and these inherent risks we've just discussed, what's the overall investment recommendation for Denison Mines? How should an investor think about approaching this opportunity?
Okay. Overall, our analysis assigns Denison Mines an investment rating of 7 out of 10. It represents a high potential play in the uranium sector. Definitely significant upside if execution proceeds as planned and if uranium prices continue their recovery, or at least hold firm.
A couple of big ifs there.
Important ifs, yes. The company's innovative IACR approach, their strong asset base, and that zero debt position, they provide a really solid foundation. However, investors absolutely should be aware of the extended timeline to production, the current lack of profitability, and that exposure to uranium price volatility.
So who is this investment best suited for?
Well, for those with the appropriate risk tolerance and a long-term investment horizon, think 3 to 5 years, maybe more, it offers an attractive opportunity to gain exposure to the uranium sector's potential resurgence. Short-term traders, they might find opportunities in uranium price-driven moves, but they face higher risk due to the stock's volatility and its pre-production status. It's not generating cash flow yet.
Makes sense. What about entry points or risk management?
The optimal entry range, based on our sources, seems to be around $1.70 to $1.80. That represents a slight discount to current prices and aligns with those technical support levels we discussed.
Clear, $1.70 to $1.80.
For risk management, maybe consider a stop loss around $1.50. A break below that would likely indicate a breakdown of key support levels. And take profit targets. Could be $2.20 to $2 for a shorter-term view, maybe $2.60 for the medium term, based on that analyst consensus, and perhaps $2.93 for a longer-term hold, closer to those highest analyst targets. Outro.
What a comprehensive look at Denison Mines. We've really covered a lot, from its unique mining approach to the critical role of uranium prices and these big global energy trends. It's clear this isn't a simple buy-and-forget investment.
Definitely not. Requires monitoring.
So, as you, our listeners, continue your own research and consider companies like Denison, maybe think about this. Remember that the future of energy isn't just about what's currently producing power. It's also very much about what's being developed right now to power the world of tomorrow. If nuclear power truly becomes the essential bedrock for emerging technologies like AI, which seems increasingly likely, imagine what new adjacent industries might emerge as the next frontier for investors. Things maybe we aren't even talking much about yet.
Like what?
Well, maybe specialized equipment for advanced reactors, or perhaps breakthroughs in advanced nuclear waste management solutions. The ripple effects of this energy shift could extend far beyond just the uranium miners themselves. It's a whole ecosystem.
Interesting thought. Lots of potential downstream effects.
Something to keep an eye on. Thank you for joining us on this deep dive. Until next time, keep exploring, keep learning, and keep asking those important questions.